So today we're going to start looking at the statement of cash flow. So I've just gone to the free encyclopedia called Wikipedia. Unfortunately, there's a lot of Americanism in that, but perhaps just because it gives us such a clear indication of the statement of cash flows, I think it is a very good place to start. Now, the Americans, they've got their own financial accounting standards board. We use, obviously, the International Accounting Standards Board. So there are a few differences in terms. The standards are similar, but they are not identical. So in the United States of America, they call it the cash flow statement. In the rest of the world, including us in South Africa, we call it the statement of cash flows. So that is a financial statement. So it's part of our complete set of financial statements that shows how changes in the balance sheet, or what we in the international community now know as the statement of financial position, how the changes in that, as well as the income, how it affects our cash and cash equivalents. We're going to come back to the term cash and cash equivalents a little bit later, and breaks the analysis down to operating, investing, and financing activities. We're going to talk about each of those three as well. And then they carry on, they say, essentially, the statement of cash flows is concerned with the flow of cash in and out of the business. As an analytical tool, the statement of cash flows is useful in determining the short-term viability of a company, particularly its ability to pay its creditors, its bills. The IASB standard, the one that we are using, is called International Accounting Standard number 7, or IAS7. The Americans use a different standard. Like I say, it's similar, but it's not identical. I think it is FAS 95, but you don't need to know that. We are just going to focus on IAS 7. Okay, let me just stop sharing that. So let's now maybe just talk a little bit about the history of this statement, because it is actually quite interesting. Just close that tab. It is actually quite interesting. This is the most recent statement, ladies and gentlemen. It hasn't even been with us for 50 years. In fact, the prototype, the very first version of the statement of cash flows, was only introduced in 1973. So as you can see, that is only 48 years ago, right? Less than 50 years ago. In its original guise, it didn't quite look like it looks today. In its original guise, way back in 1973, it started with the profit before tax, which is a figure that we find on the face of our statement of comprehensive income. And then it did all kinds of adjustments that we are going to be talking about today as well. All sorts of adjustments until it reaches something we refer to as cash generated from operations. And the operations part is quite important, that you don't call it operating activities, because we'll see later on why. There is a certain section in our statement of cash flows which is called the operating activities section, but there we can distinguish between two subsections: the operations part and then the other operating activities part. Now, ladies and gents, what happened is in I think it was 1994, a new way of presenting the cash flow statement, or statement of cash flows, was actually derived by the International Accounting Standards Board. It is probably a better explanation of the inflows and outflows of cash within a business, right? Now, that original guys, and then that was introduced in 1974, is still with us, ladies and gentlemen, but now we refer to that as the indirect method of presenting your cash flows, right? So the original one, it actually had a slightly different name. You don't need to know this. I'm just telling you for interest's sake, right? Originally, the original one from 1973 was actually called a statement of source and application of funds. Whew, mouthful, right? Long name. a statement of source and application of funds. So that still lives with us today, but we refer to that as the indirect method, right? But the one that we are going to present is the direct method, the more modern one that was introduced in the early 1990s. I think it was 1994, right? Now, ladies and gentlemen, now if I take you back to the beginning of the year, right, when we did IAS1, the presentation of financial statements, you remember at that point in time, we said there are 5 different financial statements, right? Statement of comprehensive income, statement of changes in equity, right? What else? Statement of financial position, the notes to the financial statements, that's 4. And the 5th one is the statement of cash flows. And at that point in time, when we did IAS1, we said that IAS1 applies to the first 4 kinds of financial statements or components of the financial statements. It does not apply to the 5th one, which is the statement of cash flows. Why does it not apply to the statement of cash flows? Because the statement of cash flows has got its own international accounting standard. We've just seen it is called IAS7. But the nucleus, the crux of the matter, ladies and gentlemen, is that the first 4 financial statements use the which method? The accrual method of determining the income or expenses or assets or liabilities or equity, those 5 elements, right? It uses the accrual basis. The big difference between those 4 statements and the statement of cash flows is that the statement of cash flow does not use the accrual basis, right? Here we only look at the cash flows, the cash basis. Now, ladies and gents, you'll remember we've said this a few times. Every time that you encounter a new financial statement, or in fact, every time that you encounter a new note to the financial statements, what is the first thing that you need to do? Let's see if somebody can type it for me. It's quite a number of words, a little sentence there. What is your first action that you must take when you encounter a new note or a new financial statement? Or does someone want to say it? You can actually only use one word if you wish. You must memorize the structure, right? You must know what it looks like. I think I've said this recently, it might have been to the first years. I said, when you are drawing up financial statements and you don't know the structure, then you do not even know where to begin, and then you're in trouble, and then you start panicking, right? So the most important thing right at the start, before we even start understanding it, which we will, the whole point of the session is that we need to understand the statement of cash flows. But before we can do that, we must know what it looks like, right? So here I'm going to display for you, first of all, the statement of cash flows on the direct method, right? And then we're going to discuss that. And then thereafter, we're going to look at a certain part of the indirect method, right? And we'll see which part we'll talk about that when we get to it, right? So let's just start with the main statement. So what we are going to do, ladies and gentlemen, the main statement, in other words, what we always refer to as the face of our statement of cash flows, we are going to present that on the direct method, right? And this is what we now see in front of us. I'm just going to scroll down to the indirect method. This indirect method, which we said earlier, is going to start with profit before tax, and it's going to end with cash generated from operations. The modern trend, ladies and gentlemen, this is what most big companies do nowadays, even probably for the last couple of decades, is to show the main statement, the face of your statement of cash flows using the direct method, and then just present this part, this note on the indirect method. Now, ladies and gentlemen, the only difference between the direct method and the indirect method is how you actually arrive at the cash generated from operations. So let's go to the direct method. Right at the top, we see, first of all, we're going to identify the company, the name of the company. We're going to identify the name of the statement, which is the statement of cash flows. We're going to identify the financial year. We're going to identify the currency that we are reporting in, and so forth. And then we get to our first of four major sections. Uh, the first of the four major sections is called cash flows from operating activities, right? Now, as you can see, that ends with a little subtotal here called cash generated from operations, right? Cash generated from operations. And then that operating activities section still carries on below that. So we'll talk about that soon. The fact is, ladies and gentlemen, when we are using the direct method, the only difference is how we arrive at the cash generated from operations. The investing activities section looks exactly the same, whichever method you use. The cash flow, the financing activities section looks exactly the same, whichever method you use. The fourth and final section, where we reconcile our opening with a closing cash and the cash equivalents, also looks exactly the same. So the only difference between the two, ladies and gentlemen, we can see here under the main section of cash flows from operating activities, we only use two line items to calculate our cash generated from operations. Those two line items being cash received, or you can call it cash receipts if you will, cash receipts or cash received from customers, and cash paid to suppliers and employees. I'm going to come back to this in a moment, and then we're going to talk about those two line items. That provides us the cash generated from operations. So the only way the two statements differ, like we said, we're going to use the direct method as the main statement. We're just going to show in the note the alternative way, the so-called old way of arriving at that same figure of cash generated from operations. What we are going to do in this case, we're going to start with profit before tax, which you know is appears on your statement of comprehensive income. So clearly it was derived by using the accrual system. And then we're going to make certain adjustments. We are going to talk about those adjustments a little bit later. We'll arrive at a subtotal called operating profit, and we'll see later on why we call it an operating profit before working capital changes. And then we have working capital changes or changes in working capital, which we'll discuss later on, which also then takes us to cash generated from operations. This might be a good time to give you a little hint. When it comes to financial accounting 3, we are going to see how we can calculate cash paid to suppliers and employees. But here in financial accounting 2, what we are going to do is we are first going to draw up the note so that we can arrive at this cash generated from operations figure, right? So this is how we're doing it in financial accounting 2. And then you're going to take that figure and you're going to transfer it to the main statement, to the face of the main statement, and you're going to put it there, right? So you're going to just copy it over from the note to the main statement, right? Then we are going to calculate cash received from customers. As you'll see later today, we are going to use a technique which we call the reconstruction of our ledger accounts to arrive at many of these figures. We're going to talk about the reason for that. Perhaps let's talk about it now and not later. The reason for that, ladies and gentlemen, is that when we have our dealings with customers, right? If we have our dealings with customers, what what system are we using when we record the sale? We are using the accrual system, ladies and gentlemen, right? So now my first, well, this is actually my second question, but this one you've got to answer for me. So if we are using the accrual system and we have a credit sale, we've made a credit sale to a customer, on which account does the accrual of that sale take place? You can type for me there. You can type any of the alternative names there. On which account? I know that you record the sale, you're going to credit the sale, but where do you actually accrue the fact that the customer owes you money before the customer pays it? Can somebody type for me there? It's easier than you think. Course we're close, but remember we are talking about customers now, right? So they owe us money. Audrey, that's correct. Siwamkele, thank you. Saviwe, yes, so that will be on the debtors account, ladies and gentlemen. So what happens on the debtors account? Quite a few things. First of all, spot on. First of all, we accrue the credit sale there, right? So we are crediting sales and we are debiting debtors, or if you want to, you can call it your accounts receivable. But what else besides that accrual of the sale? What else do we also record on the debtors account? Let's see if you can give me an answer there. There are quite a number of things, but there's one other obvious one. What else do we record on that debtors account a few months into the future? Maybe 45 days into the future or 60 days. There I'm giving you a hint. There could be interest. There could be interest if they are paying late. Thank you, Kauthar. And Sulele, yes, the money, guys, bank, right? What does that represent? What does that represent? When the customer makes payment on the account, right? So when the customer makes payment on the account, we are clearly going to debit our bank account and we are going to credit debtors, ladies and gentlemen, right? So you can see we are forming a pattern here, right? Thank you, Glody. Exactly. We are forming a pattern here. It means that that account where the accrual takes place is also the account where the money is recorded. When the money is either paid to us, we receive the money, or in the case of suppliers and employees, when we pay the money to them, right? So it means if we reconstruct that account by using the other financial statements, we can arrive at the cash flow, right? So if we have an opening balance, for instance, on the debit side of our debtors account, and we have a closing balance, and both of them we can find on the face of our statement of financial position, and we know that we can find revenue from sales from our statement of comprehensive income. If we reconstruct the account, we include all of those totals or those figures in their totality. It means the only missing one, the balancing figure, will represent the flow of cash, right? That is the point that we are making here, ladies and gentlemen. So the method or the technique that we are going to employ to arrive at the cash flows is to reconstruct those accounts on which the accruals took place, because those are normally the same accounts where the cash flows would have been recorded. Now, I know this is a little bit of a simplification later on when we get to the investing activities. We'll see it's not only one account. There could be two accounts. They can even sometimes be three accounts that you'll have to reconstruct in order to determine what the flow of cash was, right? But anyway, that is the principle. Okay, ladies and gentlemen, so let us just go back to what this statement looks like. So first of all, we've got this section that deals with operating activities. So we call it the cash flows from operating activities. And then this consists of two subsections. The first being the three lines there. Those three lines: cash received from customers, cash paid to suppliers and employees, And that gives us that subtotal is the cash generated from operations. We often refer to that as the operations part of the operating activities section. All right. So then we've got a subtotal there, ladies and gentlemen. Then there are five, and I can tell you it's a maximum of five activities that are they are deemed part of operating activities. There have been debates over the years, especially in the 1990s, whether some of those activities shouldn't be shown under other sections, right? For instance, whether interest received and dividends received shouldn't rather be shown under investing activities. But over the years, the consensus has been reached that no, when it comes to the investing and the financing activities, they should only represent the capital. Any income or expenses derived from your investing activities or from your financing activities should rather be seen as part of your operating activities, not part of the operations. This is now our second little section here, below the cash generated from operations, where we indicate the maximum of five possibilities, ladies and gents. To make life easy for yourself, memorize them, know what they are. So the five possibilities are: firstly, interest received; secondly, dividends received. Doesn't really matter which order you do it in, but this is normally the order that I presented when I draw up financial statements. So interest received, dividends received, then interest paid, dividends paid, and income tax paid, ladies and gentlemen. Right. Now I want you to be very clear on this. You'll see in each case the word, if it is related to an income, we use the word received here, because this is not an income. This is not an expense. This is the flow of cash, right? Uh, if it's an expense or it is related to an expense, these are not expenses, these are not income, but if they are related to an expense and we eventually have to pay that expense, we refer to these items as interest paid or dividends paid or income tax paid. Right. Now I've said too much. Now I want you to say a few things, ladies and gentlemen. If we look at that five possibilities, let's get this very clear for ourselves. If you can type for me there, please. In the very first line item for us here, interest received, which refers to a cash flow. To which income is it related? Because if you know that, you've got a starting point on trying to find the cash flows. So to which income is interest received related to? Again, it's easier than you think. Be bold. Type for me there, please. To which income is it closely related? It starts with an I. Of course, ladies and gentlemen, it is related to, easier than you think, it is related to interest income. We know that interest income forms part of our revenue, right? So that is an item that is in our statement of comprehensive income, but it has been calculated using the accrual system, right? But this is not the same animal. This is something different. This is the cash flow. So this is not the interest that we have accrued. This is the interest that we've received physically into our bank account, right? Let's look at the next one. Dividends received. To which income is that closely related? Easier than you think. Type for me there, please. Starts with a D. It's part of your revenue. Lodi, the question is, to which this cash flow, dividends received, to which income is that closely related to? something that's part of your revenue as well, ladies and gentlemen. It is related to dividend income, right? That's why I said it starts with a D. Right. Thank you, Annalisa. Thank you so much. Correct. It is related to dividend income. Then we've got the three outflows of cash. Let's go to interest paid. Interest paid, to which expense is it closely related to? You can use one of two names. The one that we sometimes just use as the name of our general ledger account, and the one that we actually use to disclose it. Correct, Sia. You get the idea. Thank you, Kondeka. So that will be closely related to interest expense. And when we disclose the interest expense on the face of our statement, you're getting the guess gist. When we disclose that interest expense on the face of our statement of comprehensive income, what do we call it then? Your finance cost, right? You remember, thank you there. Thank you, Campus Griller. I must still visit your store. I'm joking. Right. So let's go to the next one. This is a little bit different than the others because it's not directly related to an expense, but it is directly related to something that we find in another statement. So if we have this cash flow item, which we refer to as dividends paid, to which item, I can give you a little hint here, you find it in your statement of changes in equity. That's why it's not actually an expense, but it is still something that you owe to a certain group of people or certain institutions, and that must eventually be paid. So your dividends paid is closely related to which item in your statement of changes in equity. I've got the whole day. Starts with a D. Thank you, Mrs. Uh, Sia, you're close, but remember, dividends for shareholders, or rather, shareholders for dividends, is normally the liability. But you are quite correct. What do we actually call it when we have that line item in our statement of changes in equity? Not. It's similar to drawing Scouther. Thank you very much. But let's now just imagine that this is a company. Dividends declared, right? Dividends declared, either ordinary dividends, if it's for your ordinary shareholders, or preference dividends. Right, ladies and gentlemen, and this one is going to be the easiest of all. If we have this cash flow item called income tax paid, to which expense is that closely related to? You find it on the face of your statement of comprehensive income. This one you'll find easy. Obviously, it starts with an I. Income tax expense. Thank you, Londeka. Thank you, Sia. Thank you, Inga. There you go. On the face of our statement of comprehensive income, we have accrued. Remember, this is an estimate. We have accrued at the end of the year our income tax expense. But we have paid provisional tax payments throughout the year. So each time we make a provisional tax payment, that's a flow of cash, right? But only at the end of the year do we actually accrue the income tax expense. So here, when we are talking about the income tax paid, it is not the same as the expense that we've accrued. Rather, it's the income tax that we've paid during the course of the year, either our provisional tax payments or possibly a top-up payment from the previous year, right? Okay, so ladies and gentlemen, as you can see, the operating activity section basically therefore deals with the day-to-day activities of the company, right? First of all, the operations section, that has to do with our wheelings and dealings with our customers on the one hand, and our wheelings and dealings with our suppliers and employees on the other hand, right? So our customers are those that are buying goods from us, or we are rendering a service to them, that kind of thing, right? Our suppliers, well, the employees, that's simply the people that we employ, our staff. The suppliers, ladies and gentlemen, here we can ask the suppliers of what? And it is really the suppliers of anything, right? So that includes your normal creditors. In other words, the suppliers of your raw materials or the suppliers of your merchandise, but also the suppliers of any other goods or services to you, right? Such as, for instance, Telkom is the supplier of your telephone services, or MWeb could be the supplier of your internet services, right? Uh, uh, Cell C or MTN or Vodacom can be the supplier of all your various cell phone services, your printing and stationery services. So anything that is rendered to you or sold to you, that comes in some form or other from a supplier. So what we are going to be disclosing in the first line item is the cash that we receive from our customers. The second line item, the cash that we pay to all our various suppliers and our employees. That then gives us the net figure, which is hopefully a positive. If that is not a positive, your company is in trouble. Okay, so at least that should be a positive, and then we call that cash generated from operations. We add the interest received, dividends received, we deduct the interest paid, dividends paid, income tax paid, and then we get a subtotal, ladies and gentlemen. Now here you've got two choices. You can pick either one. I'll tell you which my favorite is. My favorite is I put the subtotal there. I'm just going to type it in for a second. I put the subtotal there, right, next to the heading of that section. But, ladies and gentlemen, you can also, if you wish, you can also show it below the lines. You can also show it there if you wish. But if you do show it there, then you've got to be careful, because then you've got to add this little description. So if that is a positive, you're going to call this little description net cash inflow from operating activities. Remember that section, just those three line items deal with the operations, but this whole section deals with your operating activities, right? So you can see if you put your subtotal there, you've just got to give it a little description. If you put your subtotal next to the subheading there, then you do not need that description. Anyway, so as you could have seen now, your operating activities deal with your day-to-day activities, your wheelings and dealings with customers, suppliers, and employees, interest that you may receive on a daily basis, dividends which you receive once in a while, perhaps from your investments in other companies, and so forth. Right. So now let's get to the next major section, ladies and gentlemen. The next major section is our investing activity section, right? Investing activity. So we're going to call it, we're going to give it a heading there, cash flows from investing activities. Now, ladies and gentlemen, perhaps there are some of you who encountered this statement at school. I know many of you have never encountered this. It is new to you. It is very different to the other financial statements. So we have to put a lot of effort into this. But perhaps if someone can give me an idea there, and I won't blame anyone if you can't give me an answer. I just want to see if anybody knows. So when we are talking about investing activities, what are we really referring to? Okay, I'm not going to wait too long. I know this is a tough one to answer. When we are talking about investing activities, and perhaps you can just make a note there, it deals with our non-current assets, right? Our non-current assets. Uh, like fixed deposits, right? Thank you, Lubabalo. Like fixed deposits, that is an investing activity, right? That is, in fact, an investment, right? Or a financial asset. Thank you also, Sange, right? So, yes, fixed assets, right? Thank you, Kondeka. Also, fixed assets, ladies and gentlemen. So, your investing activities deal with your non current assets. So, it deals with property, plant, and equipment. As you know, we've done that recently. It deals with intangible assets. It deals with financial assets, such as fixed deposits. If the fixed deposit has a term of longer than 12 years, 12 months, I should say, if the fixed deposit, if you can actually access it within 12 months after your financial year end date, then it will be part of your cash and cash equivalents. We'll talk about that hopefully at a later stage. But if you cannot access that fixed deposit, if it's a 5-year or 2-year fixed deposit and you only made the deposit today, and you can only access it, let's say, 5 months after the following financial year end, right? In other words, let's say 17 months after this financial year end, then it'll be part of your investing activities, right? Biological assets, ladies and gentlemen, such as sheep or your vineyards or cows for milk, right? So all of those are non-current assets. So your investing activities simply deal with non-current assets. Now, Londeka has actually given me or has answered my next question. When it comes to your cash flows from investing activities, you may have many line items because you've got many categories of property, plant, and equipment, and you've got many categories of non-current assets. But in all cases, ladies and gents, in all cases, there will only be two kinds of cash flows. Only two kinds of cash flows. Either, like Londeka said there, the acquisition, right? Thank you. And Abbas has got to the next one already, right? So it'll either be the acquisition of non-current assets, which will represent an outflow of cash, right? Or it will be the proceeds from the disposal of non-current asset, as Abbas said there. If it's the proceeds from the disposal, it means it is an inflow, ladies and gentlemen, right? So those are the only two kinds of activities you'll find under investing activities. But like I said, there could be many line items, right? There can be proceeds on sale of land and acquisition of land, and proceeds on sale, on disposal of motor vehicles, and proceeds on disposal of office furniture. So there can be many line items, but it's either going to be proceeds on disposal of some non-current asset, or it's going to be the acquisition of a non-current asset, or many non-current assets, right? So anyway, so those are your investing activities. Now let's get to the third major section. The third major section is cash flows from financing activities. Cash flows from financing activities, ladies and gents. And I'd like you to make a little note here again. This is just to make it easy for you. The only kinds of items that we are dealing with when we are talking about financing activities are loan capital and own capital. I always like something that rhymes, makes it easy for me to remember. Okay, so own capital or loan capital. What in the case of a company will constitute own capital? If you can type for me there, please, ladies and gents. In the case of a company, what will constitute own capital? You know, if it's a sole trader, you simply call it capital, right? Capital introduced, your owner's capital account. But in the case of the company which we are dealing with now, what represents your own capital? Starts with an S. Share capital. Thank you, Campus Griller. Your share capital, right? The share capital, either ordinary share capital or preference share capital, right? That is your own capital, ladies and gentlemen. And again, just like was the case with investing activities, there are only two kinds of transactions that can take place here. Only two. Either, well, perhaps you can type it there, ladies and gentlemen. It's similar to what we had under investing activities. Either you are issuing new shares to your existing, or a buyback. Thank you, Campus Griller. Thank you, Abbas. So those are the only two possibilities. On the inflow side is the proceeds on issue of shares. So if you issue shares, unless it's a capitalization issue, you know, that's that one little exception to the rule. A capitalization issue does not involve the flow of money, but all other kinds of issues do. So if you receive money from the issue of shares, we're going to call that proceeds on issue of ordinary share capital, or proceeds on issue of preference share capital. Or like you said, if it's an outflow, ladies and gentlemen, it could be a buyback of ordinary shares. Or in the case of preference shares, what do we refer to that then? Then it's not a buyback, it's a, starts with an R. If there's an outflow, if you return some of the money to your preference share holders, then we don't call it a buyback. A buyback is normally referred to in the case of ordinary share capital. What do we call it in the case of redemption? Thank you, Campus Griller. Are you sure you're not a third year student? I'm joking. I'm pulling your leg. Right. Thank you, Sange, as well. So a redemption of preference shares. That will be the outflow. Thank you, Glody. Right, ladies and gentlemen, so those are the three of the four main sections. Those are the only three sections that deal with specific activities. Again, ladies and gentlemen, it's up to you. You've got the choice. I normally put my subtotal next to the subheading there for investing activities, or next to the subheading there for financing activities. But if you want to show it at the bottom, then you've got to give it a little description as well, right? In either of those cases. Our next step, ladies and gentlemen, and now we get to our fourth and final section. We've got three sections that deal with activities. Our fourth section is a reconciliation section. So our next step, and for the life of me, I don't know why many students tend to do this in a different order, but this is the order in which you should do it. Once you've got those three subtotals, you've got a subtotal there, right? You've got a subtotal there, you've got a subtotal there. All the positives you add up, if one of them or two of them is in brackets, if it's a negative, then you obviously deduct it. And ladies and gentlemen, this is before we even talk further about that reconciliation section. Another important thing here, like with many financial statements, like with many notes, we do not have a debit side and a credit side. We've got one column for all our figures. And if we are drawing up the financial statements, we'll have one column for the comparative figures. So we have to distinguish between inflows and outflows. So, ladies and gentlemen, when it comes to the inflows of cash, we are going to show them as positives, which is really logical because it's a positive thing. Don't you like receiving money? Yes or no? Do you like receiving money? Yes or no? Yes, me too, even though I never almost do. But anyway, yes, we do. Thank you, Nelisiwe. Thank you all. Right. So that is a positive thing for us. So we're going to show that as a negative. Now, I'm a very stingy person. I do not let go of my money easily, right? Do you like when money leaves your bank account? Boo! No, we don't. Thank you, Kilisiwe. No, we don't. Right. So it's a negative thing for us. No, thank you, Londeka. We don't. Right. So it's a negative thing. So when money leaves, when it's an outflow of cash, we're going to show that in brackets as a negative. I know I made a long story of this, but the point is really to distinguish between inflows, which are indicated as positives, and outflows, which are indicated as negatives, so that your statement correctly adds up. Right. Okay, so let's go back to the reconciliation section. So once we've got those three subtotals, ladies and gentlemen, then the first line item we have here is we add them up. So we add the positives and we deduct the negatives and we get a total here. And if that total is a positive, we call it net increase in cash and cash equivalents, right? Net increase in cash and cash equivalents. If that happens to be a negative, then we're going to call it a net decrease in cash and cash equivalents. Now, what are cash and cash equivalents, ladies and gentlemen? Cash is literally coins and banknotes, right? So it will include your petty cash and your cash float. So anything that is literally in cash. What is a cash equivalent? A cash equivalent is something like a bank account where the money is readily available, right? So if it's a current account, the money is immediately available, so that's a cash equivalent. If it's a savings account, the money is immediately available, so it's a cash equivalent. If you can access that, in fact, I think IAS7 gives us a guideline somewhere, can't remember the paragraph, but if you can access it within a reasonable time, right? Say, let's say within 6 months, then it will be seen as a cash equivalent. So perhaps even a 32-day notice deposit will still be seen as a cash equivalent. But a 2-year fixed deposit that you cannot access with the money within 12 months after the financial year end will not be seen as a cash equivalent. Then it will be seen as an investing activity, right? Because clearly that will also be shown under non-current assets, the balance that's invested. Right, the next line item, ladies and gentlemen, is our cash and cash equivalents. In other words, physical cash in our bank accounts where we can access the money readily at the beginning of the period. And if this period is a full calendar year, you can also call that cash and cash equivalents at the beginning of the year. But ladies and gentlemen, please do not just call it bank account, because that is not only the bank account, right? It could be various bank accounts. It could be cash, petty cash, cash flows. So please use the words. You saw it in the Wikipedia right at the beginning of the class. Use the words as they come from IAS7, which is cash and cash equivalents at the beginning of the period. You also remember when we did IAS1 at the beginning of the year, when we drew up our financial statements, in particular, our statement of financial position, we said we call the combination of our cash and our bank accounts cash and cash equivalents. Right, ladies and gentlemen? If you happen to have a bank overdraft, that will be a negative. So that is our cash and cash equivalents at the end of the period. And then finally, we've got our cash and cash equivalents at the end of the period, right? So we first have the movement in the cash for the year, the increase or decrease, then the balance at the beginning of the period, and then the balances at the end of the period. Okay, so that is the structure of our statement of cash flow. So let us just pause there for a minute or so. Let's see if you've got any questions, ladies and gentlemen. You're welcome to ask. Welcome to ask in person, or I've got my eye on the chat if you wish. Going, gone. Okay, no questions. Looks like everything's fine so far. Don't worry. Mr. Borman is going to put all these into practice in a few minutes, right? So then we are going to look at real situations where we have real figures. I'm just giving you the structure, and at the beginning a little bit of history as well. Okay, so now let's go to our note. Like I say, the note which accompanies that statement of cash flows is basically just the cash generated from operations subsection, calculated and presented and disclosed in a different fashion, right? So here we start, ladies and gentlemen, with a little heading. So we've still got to identify the name of the entity. We still got to identify the specific financial statements or notes in this case. We still got to identify our reporting currency. But then we're going to have a little or a little heading here, and we're going to call that reconciliation of profit before tax. In other words, a figure that we have on the face of our statement of comprehensive income with our target, the one that we want to derive, the one that we want to work towards, which is the cash generated from operations, ladies and gents. Okay, so we start with profit before tax. As you know, we find that right from the face of our statement of comprehensive income. But we also know, ladies and gentlemen, that has been calculated using the accrual system. What we also know, ladies and gents, is that profit before tax includes incomes that might not necessarily be part of your operations, such as interest income, right? Or such as there might be some expenses that's not part of your operations, such as, for instance, your I can't think of one now, such as, for instance, depreciation. That's it. That's one. Depreciation is not part of operations. It's part of your investing activities, ladies and gents. So what I'm leading up to here is when we start with our profit before tax, that figure includes certain income items and it includes certain expense items that are not part of operations, which means we have to take them out. And this is what this section is for, which we have this little subheading for, which we say adjustments for. Right. So what are we going to adjust? If there's any income that does not form part of operations such as dividend income, right? Then we are going to take it out. But now we must remember that dividend income was added in your statement of comprehensive income to arrive at profit before tax. So now if we want to take it out, do we have to add it now here or do we have to deduct it? If you can just for me, please. Add or deduct. Now, in this note, it was already added to arrive at profit before tax. Now you want to take it out of it. What must you do now? Uh, Deduct. Thank you, Atinkosi Sange, Kona, Kauser. Thank you. Now you have to deduct it. So now you have to show it as a negative. Let's look at the opposite, where you've got an expense such as depreciation expense, which is part of your, which kind of activity? It's part of your investing activity. So it is not part of even, it's not part of operations. It's not even part of operating activities at all, right? So that means your depreciation has already been deducted in your statement of comprehensive income in arriving at your profit before tax figure. But now it's not part of operation. So if you want to take that depreciation out, do you have to add it back here or deduct it? Thank you, Annalisa, as well. Now you've got to add it back. Thank you, Atenkosi. Thank you, Kauter, Sange. Thank you. Right. So now you've got to add it back. So you can see for those adjustments for items that are not part of your operations, if they had originally been added to arrive at profit before tax, now you've got to deduct it. You've got to do the opposite. Or if they've originally been deducted, now you've got to do the opposite. You've got to add them back. Okay. Now, ladies and gentlemen, let me ask you a little bit of a trick question here. Once we have done that, right? Once we have done that, once we've taken out those items that are not part of operations, do we have a cash flow yet? Just type for me yes or no. Have we converted it to a cash flow yet? Or are we still sitting with either a profit or a loss? Cash flow, you can just say yes, we've got a cash flow now, or no, we don't have a cash flow now. It's a trick question, I know. The fact is, ladies and gentlemen, we haven't eliminated. Thank you, Annalisa. You're quite correct. Thank you, Siwamkele. Thank you, Atenkosi. Thank you. Right. So we're still sitting with either a profit if it's positive or a loss if it's negative. It hasn't been converted to a cash flow yet. So therefore, the subtotal that we get there, we can't call cash yet. You can't call it cash yet. It's still either a profit or a loss. But now it's not a net profit anymore. Now, this profit, anything that has to do with your other operating activities and any expense or income that has to do with your investing properties, activities, I'm sorry, has been eliminated. So this profit only relates to operations. So we call it an operating profit, right? Operating profit. And then we carry on, we say before working capital changes, because when we get to the working capital changes, we are now going to eliminate the effect of the accrual system, ladies and gentlemen. Right. Now, the first thing I guess that we need to understand is what is meant by working capital. It is a term that we also encounter. You're going to encounter it in Financial Accounting 3 when you do the analysis and interpretation of financial statements. So let me give you it now because it's handy here as well. Your working capital are those current assets and current liabilities that relate directly to your operations, right? Current assets or current liabilities that relate directly to your operations. Now let's go and have a look. What does our operations section tell us? Our operation section gives us two line items: cash received from customers, cash paid to suppliers and employees. And we said the suppliers could be your normal creditors, or it could be your suppliers of services. So, ladies and gentlemen, it really means when you look at your current assets and your current liabilities, the only working capital that you will encounter will either be your trade and other receivables. In other words, your debtors and your prepayments, things like that, right? So your trade and other receivables. The second one will be inventory. And the third one will be your dealings with your suppliers, will be your trade and other payables, ladies and gentlemen. So here what we need to do is to go and see whether there was an increase in them from the beginning of the year to the end of the year. So if it's an asset, a current asset, ladies and gents, such as inventory or such as our trade and other receivables, what does it mean if it has increased? If it has increased from the beginning of the year to the end of the year, it means, ladies and gents, that more of our money is tied up in that asset. In the case of inventory, more of our money is actually sitting in our warehouse than last year, right? Or if there had been a decrease in inventory from the beginning of the year to the end of the year, less of our money is tied up in inventory, less of the money is sitting in our warehouse, more of the money is in our bank account, right? So if there's an increase in the current asset, it is similar to an outflow. It is not, these are not flows of cash, it's just similar to an outflow because you now have more money tied up in your inventory, or you have more money tied up in your debtors account, right? Clearly, if your debtors balance has decreased from the beginning to the end of the year, you can look at it in two ways. You can either say less of your money is tied up in my debtors balance at the end of this year, or you can say the debtors have paid me as a company better this year than last year, right? So that will then be similar to an inflow. So if it has decreased, we're going to show it as a negative. And if it has, as a positive, I mean, an inflow similar to an inflow. And if it has increased, more money, more of our money is tied up in that asset, less is in our bank account. That is similar to an outflow, so we're going to show it as a negative. In the case of the liability, the trade and other payables, it works differently. There, it is not our money that is tied up in an asset. It is how well are we making use of the credit facilities that the customer has provided us. So clearly, if we have got a larger amount outstanding to our creditors at the end of the year than last year, it means we have made better use of their credit facilities. Or if you want to look at it differently, we have paid them poorer this year as compared to last year because there's a bigger amount outstanding, right? So that will then represent a positive. It'll be similar to an inflow of cash. If the creditors balance is less at the end of this year than last year, it means we have made not as good use of their credit facilities this year compared to last year, because we've paid them better this year compared to last year. So that will be similar to an outflow. So you'll show it as a negative. I've run out of time for my shift for the first session, ladies and gentlemen, but we are done in any case. So just your final figure, what is that called? That's the one that you're going to transfer to the face of your statement of cash flows, cash generated from operations. And remember, this excludes these so-called 5 other operating activities. This only relates to operations. So don't call that cash generated from operating activities. This only has to do with your wheelings and dealings with your customers and your employees and your suppliers, right? Not with interest received, not with interest income either, or with dividends paid or dividend declared. It has nothing to do with that, only with your operations. Thank you so much, ladies and gentlemen. That is my shift. Let me just check whether there are any questions from your side. Doesn't seem to be. Okay, then I'm going to sign out. Mr. Borman, shall we give them 3 minutes? It's now 3 minutes past. Shall we give them until, let's say, a few minutes, just as